The S&P, Nasdaq, and the Dow just absolutely obliterated their all-time highs right after June's labor report sent shockwaves through Wall Street. Yes, you heard me. 147,000 new jobs versus the projected 110,000. Now, that's not a tweak, that's a tectonic shift. And it didn't just rattle portfolios, it shook bond markets, crushed rate cut expectations for July, and it lit a fire under the tech giants. But here's the million-dollar question. Will this momentum keep fueling the rally, or is the Fed about to slam on the brakes? Are you ready to be on the inside of this move, or are you stuck on the sidelines watching others cash in? So, yesterday, the Bureau of Labor Statistics released stunning analysis: 147,000 new jobs, well above the consensus of 110,000. The unemployment rate dipped to 4.1%, not the predicted 4.3, further solidifying the market's belief in sustained strength. Yet, beneath the headlines lies nuance. Nearly half of these gains originated in state and local government, especially education, while the private sector hiring lagged at just 74,000, and that's the lowest since October 2024. Even more telling, while federal jobs dropped by 7,000 and labor force participation fell to just 62.3%, and that's the lowest level since early 2022. And foreign born worker participation fell even harder, hinting obviously at ripple effects from the immigration policy shifts. Now, this all paints a picture. Sure, the headline looks rosy, but core private hiring and broad workforce engagement are really softening. Now, that's a flag for those watching for cracks in the labor strength, and the market wasted no time. The S&P jumped around 0.8%. Nasdaq surged nearly 1%, and the Dow added roughly 350 points, each logging fresh record territory. Now, excuse me, major tech names, especially chipmaker Nvidia, drove the push, buoyed by easing trade concerns and renewed enthusiasm. But meanwhile, bond yields climbed. The 10-year Treasury rose to about 4.34%, and the 2-year touched 3.88%. Now, that reflects market dialing back expectations for July's rate cut. So here's a beautiful irony. Strong jobs numbers fuel stock rallies, even as they kill rate cut hopes, sending yields higher. For now, growth wins, but the question is the party sustainable? Now, with this data, the CME FedWatch tool slashed the odds of a July rate cut from around 24% to a mere 5 to 7%. So don't go waiting for it to happen in July. Traders aren't even whispering about cuts in July anymore. Now, that noise now shifts to September, where the chance of a quarter point cut sits at around 71%, which is pretty good odds. Now, Atlanta Fed President Raphael Bostic weighed in, reinforcing this cautious wait and see tone. He warned that tariff policies under Trump could push inflation higher, and it might take over a year for those effects to fully play out. So he argues the Fed needs to hold steady. He still sees a single rate cut this year, but emphasized there's no need to rush. But others, like Waller and Bowman, are very open, but consensus leads towards caution. And of course, let's not ignore Trump's demands. He publicly called for deep cuts, potentially down to 1%, calling the Fed's pause monetary malpractice. Yet, the Fed remains resolute in its independence, aiming to tame inflation before considering easing, even if it does face mounting political pressure. Oh, and by the way, if you're finding this valuable, welcome to the Financial Freedom Network, the channel that pulls back the curtain on money, credit, and your future. So if you want to keep more of your hard earned cash, improve your credit score, and stay ahead of the financial curve, smash that like button and subscribe right now. Here's the honest truth. Every video we release could shift the way that you live, and this one's no exception. So let's keep going. So, even beyond the labor numbers, we're seeing ripple effects in prices. Inflation remains stubbornly above the Fed's 2% target, climbing to roughly 2.8% in February, with expectations drifting upwards after Trump's tariff moves. Now, business sentiment, on the other hand, is mixed. Some firms have yet to pass costs on to consumer, but Bostic warns they will pretty soon, and that will force the Fed's hand. The labor force participation dip, well, that suggests economic slowdown. People are discouraged or dropping out. And if you combine that with soft private sector job growth and rising policy driven price pressure, well, you get a cautionary cocktail for the markets. So the question is, how should you position yourself? So let's take a close look. First of all, the equity markets. So growth and tech sectors are riding high thanks to bullish sentiment, but risk remains. If the Fed holds longer, yields could possibly climb further, pressuring valuation heavy stocks. Bonds and rates. Well, yields on mortgages and corporate debt are climbing. So for those considering a home purchase or refinancing, it may be pretty smart to lock in rates right now, even if cuts are likely in September. Now, what about the sector playbook? Well, financials could benefit from wider yields. Consumer discretionary also looks pretty strong. Meanwhile, home builders and utilities, well, they may face headwinds until rate cuts materialize. Inflation protected assets, well, given tariff risks and price volatility, you should definitely consider adding TIPS or inflation linked funds as hedges, judging by Bostic's warnings and obviously the tariff data. Now, next, the global and trade dynamics. Well, markets are also cheering the easing of trade tensions, especially in semiconductors and with new US Vietnam trade deals. But, as always, headline volatility remains. So, if trade policy turns frosty again, you can expect renewed market swings. So, here's the bottom line. June's stellar job growth and unemployment drop, well, it sparked thrilling market highs. But if you read between the lines, the nuance tells a different tale. Private sector weakness, dwindling workforce participation, tariff driven inflation, well, all of those, they point to caution. So markets are betting on a September rate cut, but the path there is anything but certain. So here's your move. Ride the wave today, or should you hedge for a slower quarter three or quarter four? Let me know where you're leaning in the comments. This strategy talk could shape 2025 wealth outcomes. And by the way, if you enjoyed this breakdown and you want to stay ahead of big financial shifts, smash that like, subscribe, and ring that bell. This channel brings you the truth packed market analysis every time the economy pivots. And I'll catch you on the next one. Have a great day.